Hello everyone, we're team Wish It Was Friday and we analyze companies in the fast food industry. Some quick facts to know about the fast food industry are that it's a $799 billion industry. 14.7 million employees are hired by the fast food industry, and lastly, the restaurant workforce makes up 10% of the entire US workforce. The four companies that we analyzed were Wendy's, Shake Shack, Sonic, and McDonald's. Some important things to know about Wendy's is that it's a franchise that has been a constant competitor and has been undervalued according to our DDM model. Shake Shack is a newer company that has recently stopped paying dividends, and additionally it has an interesting net income trend. Sonic has been a steady company in the past, but has recently been reporting a negative return on equity. And McDonald's is a solid company and has comparable numbers to Wendy's, but has been overvalued in the DDM model. The two companies that we decided to focus more on after doing our initial analysis were Wendy's and McDonald's. These are the two companies that stood out to us after our calculations, and apart from their well-established history, both companies were portrayed as being undervalued through our calculations. DDM was the one that showed Wendy's as being undervalued, while FCFE was the one that showed McDonald's as being undervalued. Taking a deeper look at Wendy's calculations, the DDM number resulted in 27.21. We decided that this was appropriate analysis for Wendy's since the company is pretty mature with 48 years of experience and stable earnings. The growth rate obtained from our calculations was 31.57%. This growth rate was concluded to be too high to apply to as a constant growth rate, and the growth model was divided into two-stage growth model instead. Looking at our FCFE calculation, we got a value of 2.84. After paying off all obligations, this is the cash that can be paid to shareholders after paying for all the expenses. The low FCFE may be due to the fact that they are paying off a large borrowing, which was done to fund their image activation program. Taking a look at the ratios, we see trailing PE, forward PE, PS, and PVGO. The trailing and forward PE, these are the measures of the price per share to earnings of the company. You generally want a low PE ratio because this means that the earnings per share are higher than the price of the stock. Here, Wendy's is far better than its competitors and also better than the industry value. They're the lowest trailing and forward PE, and compared to the industry average, they're significantly lower. Price to sale ratio, this is a measure of how much investors pay per share to the amount of money the company makes per share. In this ratio, you would like a lower price to share ratio. This shows that the company is making about as much money per share as the investor is buying per share. Sonic has the best price to sales ratio, but Wendy's is a close second. And lastly, PVGO was a positive value, which supports the fact that the ROE, which was calculated to be 48.73%, is greater than the required rate of return, which was calculated to be 5.4% for Wendy's. This goes on to show that the stock price will increase if the company reinvests some of its earnings for further growth. So in conclusion, we believe that the best company to invest in out of our four that were analyzed was Wendy's. The values in majority of our calculations was the one that came in best. We also see that that has opportunity for growth in both the overseas business that it's expanding into and by the continuation of their image activation program. Thanks for watching.